Welcome to today's discussion on post-COVID-19 corporate tax policy. I'm Ben Willis, contributing editor with Tax Notes. This is the second of 8 webinars on post-COVID-19 government responses to spur economic growth, all coordinated by the International Tax and Investment Center. The ITIC has continuously brought invaluable research and information to developing countries as well as the world since 1993. Tax Notes International has teamed up with the ITC to host webinars covering the 8-paper series on post-pandemic recovery. These papers and corresponding webinars focus on raising revenue while protecting economic growth and investment. The focus of today's discussion is a paper published on September 14th titled Post-COVID Corporate Tax Policy. The author and today's guest is none other than Professor Jack Mintz, and he has been publishing with Tax Notes since 1994. Professor Mintz is President's Fellow at the University of Calgary and National Policy Advisor at EY Canada. Having done a decent amount of tax work in Canada myself, I know the importance of Professor Mintz's writings. But Professor Mintz, could you give us a little background on yourself as well as what led to today's paper?
Well, thank you very much, Ben. This is a pleasure for me to join you today and talk about the paper that I did do for ITIC. Let me first, just in answer to your question, give a bit of background for people who have joined in. First of all, I've been engaged in tax policy for almost all my academic career, going right back to 1978. I have done some other topics as well, but it's been a keen interest of mine. And in fact, back in 1984 to 86, I was asked to come up to the Department of Finance in Ottawa. And at that time, I wrote the paper that went out on restructuring the corporate tax, which was the very first tax reform we had on corporate taxation for some time in Canada, which came out with Michael Wilson's 1985 budget at that point, which was, the usual thing, lowering rates and broadening tax bases. At a later time, I was invited back to the Department of Finance as a Clifford Clark visiting economist in 1996 and 97. And I was asked by the Honorable Paul Martin, who was the Minister of Finance at that time, to chair a business tax reform panel that actually did lead to very significant changes in corporate tax policy in Canada from 2000 onwards, which were, again, in the usual sort of thing that economists often like to recommend, lowering rates and broadening bases. And I've also done a lot of tax reform in various parts of the world for the World Bank and the IMF on various missions. And in fact, I forget how many countries I've been to or worked on over the years, but it's been quite a large number. Now, just to answer your other question, what is this paper about? Well, I was asked to think about post-COVID policy, and I thought the very first thing I should do is ask the question, what happened after the last major recession we had, which was the 2008 financial crisis? And the reason I thought it would be appropriate to look at that experience, because at that time, large deficits were created. It was a different type of recession than we're going through now. But it would have been interesting to sort of ask the question, do governments ramp up taxes and tried to deal with their deficits by actually raising tax GDP ratios quite a bit? And the answer to that question actually was no, they didn't. In fact, the tax GDP ratio obviously fell quite dramatically across the OECD in 2009 and 2010 because of the loss in revenues, as one might expect with a recession. It then started rising because of the recovery that was taking place. But interestingly, the weighted average tax GDP ratio amongst OECD countries by 2015 was really no different than it was in 2007. And so governments really didn't address the shortage by raising taxes. Instead, they actually kind of held the line on expenditure, and let their budgets balance with primarily with growth. And there were changes in tax policy. It didn't mean, even though the level of taxes didn't change a lot over the period, but the changes were quite dramatic in the sense of raising top personal rates for redistributive reasons, and then relying somewhat more on payroll taxes, property taxes, sin taxes, and other excise taxes. So those things did happen, and some countries did raise their value-added tax rates. So there was some changes in tax policy, but there were also some reductions that took place, especially for low and middle income earners, where a number of governments actually wanted to cut taxes in that case. And so the overall tax GDP ratio didn't change. So if we go to this COVID experience, what this paper really talks about, it goes through that experience and saying, okay, will that happen? Or at least we shouldn't presume that tax levels as a share of GDP will ultimately rise after the COVID recession, except for growth. That will depend on what governments do. And in fact, because of very low interest rates, I think there's a predilection amongst many governments to say, you know what, we'll just let debt rise, and we'll let the economy come back that way. But there are a lot of questions being raised about how to grow back the economy, and I think that's where corporate tax policy is absolutely critical in terms of how to grow the economy ultimately. And the paper goes into a number of pressure issues that are clearly related to the fact that we've had a major supply shock with the COVID recession, and we're going to need to get people back to work. And so ultimately, corporate tax policy is critical. And in fact, when you look at what happened after the 2008 recession, corporate tax rates actually kept declining to a certain extent. Some countries raised it, but generally, on average, they fell. And in fact, there was some base broadening and things like that went on the corporate tax side. But generally, governments did not look to raise corporate taxes because they were concerned about investment and getting economies back on their feet. And I would suggest that probably that will continue to be the case post-COVID, as we need to build productive capacity after the supply shock.
So would you say that these approaches that you've discussed and described in detail in your article were in fact successful following the Great Recession in 2008 in helping countries rebound from that recession?
Well, it's a good question, because when you look at the recovery after 2008-9, it was not exactly a fast recovery. It took many years for economies to get back on their feet. And in fact, growth rates declined partly because of demographics. We're having fewer people coming into the workforce, especially in the advanced countries. That's not true of all countries, but it is true particularly in the advanced countries. And so when you think of growth, it's really adding up the growth rate in workforce plus productivity rates. And productivity did not gain very much either. In fact, in most cases, it's still in relatively around one, depending on the country, around 1.5%. And for labor productivity and labor force growth, maybe 1%, maybe half point, depending on the country. And so when you kind of add the two together, we're seeing 2% growth rates, which is quite a bit lower than what it was at one time when we had 3% growth rates. About 20 years ago, which was a more likely case, 2%, or even some countries having higher because of better productivity. So then you actually had better growth rates at that time, particularly amongst the advanced countries. But there are important exceptions, obviously China being a very important exception.
Yeah. One of my biggest concerns is the competitiveness that has already gone on. One of the things that I like so much about your article, and I think many should really look at it when considering tax reform, because it really does a great job of not only covering at a high level a lot of approaches that the world had taken after the last big recession, but also it takes into account so many factors that are now relevant in this pandemic and for this upcoming recession, which a lot of economists are predicting will be larger than the Great Recession. And so uh, when it comes down to competitiveness, what concerns me is that we've already been in a historically competitive environment, and rates have already continuously gone down. And now, at least for the U.S., we're looking at one of our largest deficits ever, at over $3 trillion. And so my concern is the balancing act that you do a great job of describing in your article, which is, how can we encourage in jobs and growth, but yet still have enough funds to provide the resources that folks need during this time of crisis.
No, actually that's a pretty important question. And so let me try to answer it in two ways. We have to remember there's other taxes too, and I think corporate tax policy has been kind of a useful tool to grow the economy. Even with the rate reductions that took place, and I know this is the case in Canada. We had dramatic rate reductions since 2000. It's fallen from an average federal provincial rate of 43% to 26% today. That's just as large as what happened in the United States in 2018. It's just we did it over many years. But I think when you actually look at corporate tax revenues as share of GDP, it didn't change very much in Canada, despite all the rate reductions. Part of that was due to some base broadening that took place. Some of it actually arose because of profit shifting. Part of it was profit shifting from the personal sector through small businesses as people formed corporations rather than being an unincorporated business. And this happened actually at the time when professionals were allowed to incorporate in like medical professionals in Canada. But it was also due to income shifting at the international level, where all of a sudden, instead of Canada having the highest corporate income tax rate in the world, it ended up being in the middle. And of course, companies that used to shift profits out of Canada found it was more attractive to leave profits in Canada, especially when the US had such a high corporate income tax rate, which was the federal rate being 35%. And so the loss in revenues wasn't as big as one would have expected. And I think that's kind of an important lesson, which is going to put some constraint on governments doing that. And that's what's going to be interesting about the US. As you know, I've written 4 tax notes international as well as tax notes. We did an evaluation of the Biden plan, which will lead to a very dramatic increase in effective tax rates on new investments in the United States over this coming decade, partly as a result of a higher corporate income tax rate, if it happens, from 21 to 28%, but also the expiration of accelerated depreciation, bonus depreciation, which I'm sure that might change. But we also have to remember that the 2018 tax reform in the US also did a lot of base broadening, limiting interest deductions and loss deductions and a whole host of things. And that could be still in place. So you could be having quite an increase in taxes on capital in the United States, while at the same time, you would be using a much bigger base than would have been existing before 2018. So that kind of raises the question of whether there'll be a retraction of some of these limitations that were imposed, or whether there'll be a reform of those things. So that'll be an interesting question. And I should point out, by the way, I don't know if you saw it, Ben, but yesterday I came across a paper by Kevin Hassett and Casey Mulligan evaluating the Biden plan, and according to their estimates, it will have a very negative impact on economic growth in the United States, which of course is important to the rest of the world, given the U.S. economy is still roughly 25% of world GDP.
Yeah. Yeah, it's very interesting, the different projections that have come about related to the Tax Cuts and Jobs Act that took place largely in 2018. obviously, our markets did extremely well. Those investors certainly benefited, particularly the wealthiest ones. But as far as wages, we didn't feel that as much as we anticipated. The influx of capital from the repatriation tax certainly didn't occur as anticipated, and so people certainly wanted to take advantage of our extremely low tax, relatively speaking, historically, and we're successful in doing that and raising those prices, and that benefits people across the world, a lot of foreigners and otherwise. But as far as actually benefiting folks in this country, it's been less fruitful than expected, and a lot of the projections anticipated. And so I think a lot of folks believe that the same calculations that are being used underlying these those calculations and these new ones on Biden's plan are part and parcel of who will economically bear the burden, and the incidence of tax, which is very difficult, as you know, to determine. But ultimately, Biden's shift, as you know, is focused largely on the wealthy, and he hasn't tried to hide that in any way, shape, or form. I mean, we have a lot of regressive taxes here in the United States, and so when up to $140,000 almost of earnings that low and middle income families are being taxed on with respect to payroll taxes, which constitute a sizable amount, over quite a large amount of one of our largest revenue raisers for our fisc, is hitting just these lower and middle income class families. He's trying to shift the burden to include wealthy folks as well, and eliminate some of the disparities that have been caused. And so I appreciate the point that there's definitely some tension here in trying to encourage investment and bring forward jobs, but yet not give away everything. And so obviously compromises need to be made, and this is the time where it needs to happen. I'm most curious, and I put forward this question to you, is um, how do you foresee that occurring and taking place on a global perspective, as far as countries collaborating and working together in this environment?
Yeah. Well, I could debate some of the things you just said,
Yeah.
which I don't think is going to be worthwhile, because I do know there's some alternative views about impact on wages and things like that. But the world is more complicated. Corporate taxes weren't the only thing that changed back in 2018. There was also tariffs brought on, and other things. And we also, the economy was actually moving closer and closer to full employment, which means you can't create as many jobs when so many people are already hired. And so, but it does mean that you put more wage pressure on. Numbers I've seen, the U.S. certainly, especially compared to Canada, there was a better acceleration of wages in the United States, and particularly at the lower end, unskilled labor, which is kind of interesting. But we'll leave that aside. Now, getting to your question about the OECD and effort and international cooperation on taxation, that's a very fascinating question to think about. So first of all, when I see what countries are doing now, and it's not just the United States, but other countries as well, is that coming out of this COVID recession, they're more worried about their ability to ensure supply of certain, let's say, required materials and goods and services. Obviously, medical equipment being a clear one, but there's been concern about food security. There's been, in my country, people have raised energy security, which I know in the U.S. was always an issue back in 30, 40 years ago, but still sometimes discussed today in the United States. But other countries certainly are worried about making sure they have their inputs available. And so they're worried about these world supply chains where they're so dependent on what's available from other countries. And so then they want to shorten those supply chains, or or secure things more in their own country. We'll see how far that goes. But what I'm suggesting is that there's going to be increased nationalistic policies. And so when you're in a more bigger thy world, bigger thy neighbor world, that will mean that, of course, countries, when it comes to their tax policy, will be perhaps less concerned about um, trying to, let's say, be competitive at the international level, but more concerned about developing their own domestic supply. And you can see that in even some of the platforms taken in other parts of the world where there's concern about building up domestic manufacturing, and that means incentives for manufacturing and for investments in manufacturing in their own countries, et cetera. And then at the same time, you have governments which is a leftover from the 2008 financial crisis. At that time, the G20 countries said, we need to do something about profit shifting and base erosion and protecting the corporate tax base, because it's not fair that corporations weren't paying enough tax, and that made people pay more tax. Although, as we know, corporations are just things on paper. Somebody pays a tax of a corporation, and it's either going to be through higher consumer prices, lower wages, and lower capital. And for most countries, unlike the United States and perhaps China, which are smaller, and I know in our country we think of this, in Canada, but I know it's also true in many countries. We don't look at the corporate tax as necessarily a tax on the rich. In fact, we look at it as a tax on labor and leading to higher consumer prices. And so the tax on capital is actually less minimized because of the fact that capital is very mobile. And if you try to tax the return on capital, then people will take their money and go to another country and invest elsewhere. And so they won't bear the tax. And instead, it'll get shifted in a way that actually it's immobile factors of production that end up paying the tax. And that's in the case of labor and land.
Do you view VATs in the same light?
Yes, we do. In fact, VATs are basically a tax on labor, which people forget about, because just as personal income taxes reduces your paycheck, VATs increase prices, domestic prices, and that's a reduction in the value of your paycheck in terms of what goods and services you can buy. So it has a similar impact on work effort in that sense, as would an income tax, at least in as leaving aside the progressivity and all those kinds of issues that are important. But you can think of it as a tax on labor and on immobile factors in that sense. So and rents, from land, etc. So those things, I think, are considerations that countries are going to have. Then the question is, to what extent will they cooperate on corporate taxes? On one hand, they do want more revenues, but on the other hand, they also want more investment. And we can maybe talk more about the OECD latest Pillar 1 and Pillar 2 agreements on digital taxation. But I think the jury's out to what extent countries are going to be willing to cooperate on pretty complex schemes to try to tax digital profits, or whether they're going to be looking at other alternative methods of taxing digital services.
Yeah, and that's a great topic for our next question. Or I'll make one comment, with respect to, I think, your good point, which was, obviously there was some wage improvement in the U.S. following the Tax Cuts and Jobs Act, but we had a 40% rate cut, and I don't think most people providing labor saw a 40% increase in their paychecks. I think the vast majority of that 40% increase didn't end up heading to workers. And obviously, again, this is a very complex issue. We could go back and forth on it for a long time, but certainly folks did benefit from that 40% cut. And whether or not it's scaled back a little bit, if in order to accommodate the recession, it will be interesting to see how things play out. But as far as the digital taxes, I think the U.S. has I don't know if instigating the current environment is the best way to say it, but it certainly captures a lot of people's sentiment. I know I've spoken with folks in Europe and in various places who have viewed us and other countries who have really help lead nationalistic policies as far as trade wars and tariffs and threats, and these have really been culminating greatly, and it gets down to your point about supply chains and whether or not cutting ourselves off from the world, any country who enacts policies that are so aggressive or counterproductive for collaboration in this environment is really going to benefit folks, or ultimately cause an increase in the cost of so many goods and services to every country almost in the world relies on other nations for their goods and services, that it'll just create the economic frictions that have led to principles about import and export neutrality and trying to minimize that. And so, I put forward to you the question of whether or not we think there are countries, any countries, will, kind of be the first to, really step forward and try to minimize the current, retaliation and tactics that are going on. And yeah, what are your thoughts on that?
Well, it's let's talk about the digital case, because I think it's such a good example, right, of the issues involved. So you really have two sorts of issues involved with digital taxation, and the first one is that let's face it, this is the one sector that has done extremely well and will continue to do well in the future. During the COVID recession, I mean, a lot of the sectors like travel and entertainment, et cetera, had huge employment losses, but not the technology sector, and that's because people were converting more and more to the use of technology, just like we're doing right now. And there's huge profits that are coming along with that. And of course, it's very tantalizing for governments to try to tax the rents, especially. Or what economists will call the economic rents associated with those profits, because of the huge value to intellectual property, and so that's one set of considerations that I think what governments may want to go after. But the other issue is who's entitled to the rents or to the income or to the profits. Is it if we continue with the corporate income tax, which is based on source-based methods, the country, particularly the United States, might say, hey, the ideas came out of our companies operating here in the United States. We're entitled to those rents and to those profits, to tax them. And it's not France, and it's not Italy, and it's not UK or Canada or other countries that want to tax corporate digital services or companies, certain digital companies, because that income belongs to us and not to them. On the other hand, the users that are providing free information to all these technology companies, one might argue that users in those countries are helping create those rents, and therefore there should be some tax on those profits. So that gets to, in my mind, to a really important point, which I think requires a lot of discussion. And that is, are we asking too much of the corporate tax system to deal with these issues? If you go back to the 1990s, when globalization was really taking place in a very strong way in terms of international capital flows, we saw that a number of experts would argue, tax experts, would argue, many people writing in your publications, that maybe the best way of trying to tax the income or the rents being generated on technology should be done on a consumption basis rather than on a source basis, income basis. The argument being that those profits get embedded in consumer prices, and if a country wants to tax them, then why not impose a tax on digital services, sales tax, as a way of trying to capture those rents? And if everybody did that, you could capture the same tax on rents as you would under a source-based tax. And so that kind of raises an interesting question. If we're really talking about digital service taxation, and this is something that the United States can't do because you don't have value-added tax, but 160 countries now have value-added taxes. They should be putting sales taxes, value-added taxes on imported digital services, whether it's Google advertising revenues or Amazon purchases or Netflix or whatever. And I think that would be a good way of actually trying to tax those rents. But instead, they're looking at presumptive corporate income taxes. But what are they? They're basically revenue taxes, which is the French one, like a 3% or 5%. In Europe, the 3 to 5% digital service taxes on revenues. Well, that's no difference than trying to put on a sales tax in that sense. So why don't we just expand the value-added tax, which is probably a good way to capture the rents, and each country can do it. And you don't need a big elaborate OECD Pillar 1, Pillar 2 mechanism to tax those rents. This could be done individually by each country.
Yeah, I think there's a lot of pros about a value-added tax. One of which is transparency. We're sitting here debating incidents of taxation and talking about how difficult some of this is to determine, but the value-added tax eliminates a lot of those questions. And now we're still in the middle of a heated debate on source and jurisdiction and nexus and where you can tax and whether or not the U.S. wants to allow destination-based taxes and give foreign tax credits for them or deny that. Yeah, it's certainly creating a lot of issues. So I appreciate the simplicity that a value-added tax would have. I know that we have some incoming questions right now, and so let me see if I can take a peek at some of them and put them forward to you. Sound good?
Mm-hmm. Sure.
Okay, great. Thanks. Just waiting for them to come in. Bear with me. Thanks, Professor, and our listeners. I know you've asked some good questions, and so just they're weeding through the many of them right now, trying to pick those that are the most related to our discussion in the topic. One point I'll make right now is while we're waiting through these technical difficulties is just that while the U.S. has been putting up such a fight with respect to digital service taxes and some of these issues, we've actually have some hypocrisy going on with respect to how we're dealing with this at a state level. And so, individual states in the U.S. are imposing digital service taxes, and we, our federal government administration wants to respect state sovereignty as much as possible, so that states can determine their own rates. Yet, when it comes to an international perspective, the views seem to change a bit on that. And then just a comment on the nationalistic approach. I think there's some sentiment there that while it could be viewed that the U.S. is focused so much on making sure that we are the winner and everyone else is not, we've created a furtherance of that internally and with respect to states as well, and enacting federal policies that have favored some states and others, and that a lot of that is based on industry and certain states that are entirely in certain industries. Some states obviously focus more on technology and have higher tax rates and get hurt by certain limitations on deductions, and so there's always some pressure there. And so I'm now getting the signal that we are past our time, and we are ready to conclude. So Jack, do you have any final statements that you'd like to make, or comments before we close and thank the audience?
No, I'll just very quickly add one point, just in comment on yours. Of course, the United States has this very anachronistic retail sales tax, which there's not, many countries have now moved away from single stage sales taxation, which is the value-added tax, because it's much broader tax on services. And in fact, I think one of the critical arguments about taxing digital services under the value-added tax is also imported ones particularly, is that it provides a level playing field. I mean, right now, here in Canada, when I buy digital service from Bell Canada or Rogers or TELUS or whatever the supplier is, I pay value-added taxes on it. Yeah. But if I get Netflix or something else, I don't pay any value-added tax. And that obviously doesn't make any sense. And so I think that's, one of the things that, we have to bear in mind. But I would also say that I don't see there's any harm in state governments in the U.S. taxing digital services per se. I mean, it's complex and there's issues around that. But tax competition also is good in many ways. And so I wouldn't exactly undermine that for that reason. I think we have to look at these things with different lens. And it's not just all about governments trying to grab more money.
Yeah, no, I agree. There's a lot of economic incentive, and a lot of countries have historically prided themselves on capitalistic nature and competition, and so there's certainly some value and something to be said for those points. So I appreciate that, and all the comments you've made today, and this fantastic article, which again I'll just reiterate. I think people really should take a peek at the post-COVID corporate tax policy article that you wrote, published on September 14th. So I will conclude by thanking everybody for joining in to today's discussion with Professor Jack Mintz and myself, and also thank the ITIC, the ITIC, for putting together these fantastic papers and this topic, which governments are very interested in right now. And of course, to thank Tax Notes for hosting these webinars. So thank you, everyone. Absolutely, Jack. Take care now. Bye, everyone.